When a major crypto platform goes public, well, the market doesn't just get a stock ticker. You get this incredibly rare, mandated look inside, a really transparent view of a complex, high-stakes business.
Hmm.
Today, we are opening the books on Gemini Space Station, Inc., or GSS. They just completed their IPO, actually closed on September 15th, 2025.
That's right. And we're diving straight into the official filings, the S-1 prospectus, the 8K documents. And honestly, what they show is this fundamental conflict.
Okay.
GSS is aiming to be the most trusted brand in crypto, built on compliance, regulation. But that strategy, it seems to come at an extraordinary cost.
How so?
Well, it creates a business that's both super centralized and, frankly, wildly volatile financially.
Right. So our mission today in this deep dive is really to unpack that tension. We'll look at the tight control the founders have, analyze these, massive financial losses just from the first half of 2025.
Yeah, they're significant.
And also examine the operational hurdles, the things kind of undermining that promise of stability they're trying to sell.
Exactly. The documents themselves are sort of two-faced. On one hand, you see this ambitious, institutionalized company, but then you look at the financials, the governance.
Yeah.
And it looks much more like a private venture, backed by these really powerful, pioneering individuals, not necessarily a public company with genuine outside accountability.
Let's start right there with the public debut itself. Because even the offering structure, it kind of tells you where the power lies, doesn't it?
It really does.
The public IPO price was $28 a share. That's for the Class A common stock. And they sold, nearly 16 million shares to the public in total?
Correct, including the underwriter's option. That brought in capital, sure. But what's really key is the institutional nod they got at the same time.
Ah, the NASDAQ piece.
Exactly. NASDAQ itself came in with a concurrent private placement, bought almost 2 million Class A shares, though at a slight discount, $26.25 a share.
Okay.
That funneled $50 million straight to GSS. It's like getting a massive stamp of approval from traditional finance right as you go public.
So institutional validation from NASDAQ, definitely. But the real power, the day-to-day control, that still sits firmly with the founders' internal structure.
Oh, absolutely. We're talking about Cameron and Tyler Winklevoss, the twins, famously early in crypto, investing in Bitcoin way back in 2012.
Legends, really. Owned like 1% of all Bitcoin at one point.
And they've used that first-mover status to build an iron grip on the company structure. Post-IPO, through their affiliates, you get this, they control about 94.7% of the total voting power.
94.7%. That number is staggering.
It is.
Does that leave any room at all for public shareholders? Can they challenge big decisions, or is this essentially just a private company trading publicly?
That's the million-dollar question, isn't it? Because they hold that voting power. GSS officially qualifies as a controlled company under NASDAQ rules.
Which means?
Which means they get exemptions. They don't need, for example, their compensation committee or nominating committee to be fully independent directors. It's governance on their terms, basically.
And this dual-class share structure, it complicates things even further for public shareholders, doesn't it? The alignment isn't straightforward.
Not at all. And this is critical if you're thinking long-term investment. Class A and Class B shares generally get treated equally in a sale on a per-share basis.
Oh.
But...
There's always a but.
Right. The filings specify if the payment in a merger is in the form of securities of another company, the founders' Class B shares can receive securities with up to 10 times the votes per share compared to the public's Class A shares.
Wow. Okay, so if the founders decide a merger is best, potentially one that solidifies their control even more, how does GSS convince public shareholders that their value is the priority?
It's tough. That structure seems designed to entrench their power almost regardless of how the market performs.
Which brings us neatly to market performance and the financials. Well, this is where things get really interesting, maybe a bit concerning.
Yeah, the numbers tell a stark story. GSS's business model is pretty standard for an exchange. They make money mostly through transaction fees based on trading volume.
Okay, but looking at the snapshot, the losses are just huge. GSS reported a net loss of $282.5 million. That's just for the first 6 months of 2025.
And compare that. In the same period in 2024, the loss was $41.4 million. So it's a sevenfold increase in losses.
Is this just crypto winter biting hard, or is there something else?
It's more than just market volatility, I think. This feels like the real cost of their whole trusted brand, compliance-heavy strategy. Look at adjusted EBITDA.
Okay.
It swung from a positive $32 million in the first half of 2024 to a negative $113.5 million in the first half of 2025.
Ooh, big swing.
Massive. They're pouring money into operational controls, compliance infrastructure, everything needed to back up that trusted claim. And clearly the trading revenue hasn't been enough to cover those costs recently.
And yet, amidst all that red ink, there are these pockets of just explosive retail growth, right?
Yeah, it's a bit paradoxical.
Monthly transacting users, MTUs, grew modestly. Okay. But look at the Gemini credit card signups. Under 3,000 in the first half of 2024. Over 23,000 in the first half of 2025.
That's huge consumer adoption, absolutely.
So what's the story there?
Well, that contrast is interesting. Retail users, they're adopting the products rapidly, like the card, and they generate most of the core exchange revenue. About 95% of it in H1 2025 came from retail transaction fees.
Right.
But the actual trading volume, overwhelmingly institutional. $21.5 billion out of $24.8 billion total volume in H1 2025 was institutional money moving.
So retail pays the bills per transaction, but institutions move the serious volume.
Exactly. It's a complex engine. And both sides are super sensitive to market swings. Like look at NFTs. Nifty gateway revenue dropped 43% in H1 2025. That market's still way down.
Yeah, the NFT cool-off continues. Just one quick clarification on that volume. When the filing mentions, say, $13.7 billion in Bitcoin volume, are they usually careful about distinguishing Bitcoin the network from Bitcoin the asset?
They generally are, yeah. Bitcoin with a capital B usually means the network, the technology. When they talk volume, they're typically talking Bitcoin lowercase or BTC, the actual cryptocurrency being traded.
Got it. So that volume reflects the asset changing hands, where their revenue and liability really sit.
Precisely. And that leads us into the risk section, because the operational and legal challenges detailed there, they directly challenge that whole trusted brand promise.
Oh.
The filings flat out admit that GSS identified material weaknesses in internal control over financial reporting back when they were a private company.
Wow. Okay, for a company going public, admitting material weaknesses, especially in exchange holding customer assets, that's a massive red flag. What exactly were the problems?
They listed four main issues, and they're pretty fundamental. First, not enough qualified people for a proper financial close process.
Okay, stop.
Second, their risk assessment controls weren't designed properly. Third, and this is huge for a custodian, inadequate controls for reconciling their internal digital asset ledgers with the public blockchain records.
Wait, so the process for checking that the crypto they say they hold in cold storage actually matches the blockchain reality? That wasn't solid.
Apparently not robust enough, no. It sounds like they were running this complex, tech-heavy financial institution with infrastructure maybe suited for a smaller, private setup.
Concerning.
And fourth, they also lacked proper controls around launching new products, which, in crypto, with its constant innovation, is a big deal. They see remediation is ongoing, but still, it definitely counters the safest place narrative.
And the ghosts of past issues are still around, too. The EARN program fallout, for instance.
Right, that settlement cost them. February 2024, they settled with the New York Department of Financial Services, the NYDFS, paid a $37 million civil penalty.
Ouch.
And, critically, had to ensure full in-kind recovery for all the EARN users. They finished distributing those assets back in June 2024. It just shows the real, tangible cost of operating under strict regulations, securities, banking, consumer protection, all of it.
Which brings us right to that compliance paradox you mentioned earlier. The documents literally say their regulated status puts them at a disadvantage competitively.
It's the core irony, isn't it? They spend millions on compliance, security, upgrades, all the things you need to do to be that trusted brand.
Great.
But that very compliance limits them.
Yeah.
They explicitly mention competing against unregulated or less regulated firms, often overseas, but also against DXs, decentralized exchanges, and DAOs, decentralized autonomous organizations.
And they feel those decentralized players have an edge.
They state that these entities might be able to innovate faster. They can offer products, maybe complex DeFi stuff, certain tokens that GSS simply can't offer because of their licenses and banking relationships.
So the drive for trust makes them slower, less agile. They're this centralized, very controlled company trying to compete in an ecosystem that's all about rapid, often unregulated change, things like staking, layer 2 networks, new dApps popping up constantly.
The fundamental challenge for them.
Okay, let's try to pull this all together. Synthesize the main takeaways from these Gemini space station filings. What we're seeing is a company built by crypto pioneers. who still hold near total voting control, that 94.7%. And they're going for a public market valuation based on this promise of trust and stability.
But that trust comes at an incredibly high price. You see it in that massive $282.5 million net loss just in the first half of 2025.
Right.
A cost driven heavily by fixing those internal control weaknesses we talked about and dealing with regulatory fallout like the earned settlement. They're trying to blend the high-speed growth parts like the credit card signups and institutional volume
Yeah, those bright
with the
spots.
really slow, really expensive demands of being a compliant public entity. Wall Street rules versus crypto speed.
It really boils down to speed versus safety then. So here's the final thought, the question really for you, the listener. Given those admitted material weaknesses in financial controls and the absolute need to keep up with nimble competitors,
Yeah.
how effectively can a heavily regulated, centrally controlled company like Gemini Space Station actually deliver on being the most trusted brand in crypto? Especially when the competition is decentralized, innovating like crazy, and often operating completely outside those regulatory fences.
That's the tightrope they have to walk. That fundamental tension between centralization and the decentralized world they operate in, that's likely going to define their entire journey as a public company.